Welcome my dear students. I am Dr. Simi Khurana from Ajay Kumar Garg Institute of Management, Ghaziabad. Today I am going to discuss Unit 2nd of Financial Derivatives and my topic is future pricing, in which I will discuss cost of carry model and their numericals. Now let us first understand the meaning of the future. Future contracts are standardized contracts. They are traded on the exchange. There is the involvement of the clearing house. There is no counterparty risk. Future pricing or the future trading plays an important role right now. Earlier, whenever we are going to buy the shares, we have to purchase in cash. Let us take an example. Just if I want to buy the share of State Bank of India, right now State Bank of India, I am just giving an example. Right now the spot price of the State Bank of India is 570 today. If you want to buy the 100 shares, how much amount you have to pay? You have to pay, multiply 100 multiply with 570, it means you have to pay 5,70,000. But right now if you want to purchase the future, you have to pay just only 5 to 10% of this amount, not the 5,70,000. That is why the future trading is right now plays a very important role and its help in the growth of the economy. Moreover, the trading in the future market is not an easy one. There is a need of the specialized knowledge. It means one should have a knowledge of the forward contracts, options, derivatives, so that they can easily trade in the futures. In the case of the futures, they are the lot size. If I will give an example of the State Bank of India, the lot size is 1500 share. It means at a time you are going to purchase the 1500 shares of the State Bank of India. We know very well that in the Nifty there are the 50 stocks and all the stocks have a certain lot size, just like Marico, they are having the lot size of 2000. There are the number of the different contracts and the operator or the hedger or the speculator or the arbitrator can do the trading in the future contract. As we know that in the case of the hedgers, they are going to avoid the risk, they are not ready to take the risk, but in the case of the arbitrators, they will get the benefit by the mispricing in the prices of the contract between two exchanges. Let us take an example again in the case of the BSE and NSE. In the money control side, you will see that if you will find out the prices of the State Bank of India, the prices shown in the NSE and the BSE, there is a little bit different, and the one could do the trading by buying or selling the future at one point and purchasing the future on the other exchange, then they will get a simultaneously profit. This is the case of the arbitration, but in the case of the speculation, my dear students, they will enter into the trade to get the benefits. They will no doubt that they are also faces the losses, but their main aim is to earn a profit. There is a need of the specialized knowledge in the case of the future trading, otherwise no one can do the future trading by just giving an idea that this is the future or that this is the option. You should have a thorough knowledge if you want to do the trade in the future market, and it is very helpful in the growth of the economy. These are essential to make the evaluation of derivative products in the terms of their prices and so that the market participants can select them as per their objective. What are their objective? If the hedger, they can enter into the contract to avoid the risk, and if the arbitrator, they are going to enter into the contract to get the benefit out of the mispricing between the two exchange, and if it is the speculator, they enter into the contract to earn a profit. Next, future price volatility. If you will see the future market, you will find that there is a lot of volatility in the future market. At the beginning of the future, at the beginning of the month, the future prices are very high, but at the date of the expiry, it is going to be equivalent to the spot rate. Let us again, I am giving the example of the State Bank of India. If you are going to take the future, at the of State Bank of India in the beginning of the month, then it is available more than the spot price. As we know that there is a cost of carry model which we will discuss why the future prices are more than the spot price, what is the reason behind that we will discuss in detail in the next slides. But right now what we are discussing about what is the difference in the why there is a volatility changes. Volatility is more on the Monday as compared to the Wednesday. There is a decay in the prices of the futures and options in the case of the Wednesday because the expiry is there, and we know that the expiry is done on every Thursday, last Thursday of every month, that is the 20 whatever the Thursday that will come. But in the case of the option, the expiry will be done in each week or weekly at the on Thursday. In the case of Monday, higher volatility has been seen, but in the case of Thursday, the less volatility is seen, and the prices of the options are going to be declined, and the futures are also having a low volatility as compared to the Monday. And here it is written that time to expiration and the future price volatility, and it is given by the renowned economist that the volatility of the future price should increase as the contract approaches expiration. In other words, near expiration there is a more volatility than in the beginning. It means the change in the future prices are more very high in the case when the prices are at the end of the expiration, but again it become to equal to the spot price. Why it is come equal to the spot price? There is a reason behind that. What is the reason? That the cost of carry becomes 0, and I will discuss the cost of carry in detail in the next slides. Then virtually all the studies agree that the future price exhibit the seasonal volatility. They are more volatile at some specific period rather than at others. Finally, there also seem to be day of the week effect in the price volatility. I have already discussed this thing that the volatility is more in on Monday as compared to the other days. Now let us discuss about cost of carry. My dear students, as you know that whenever there is a difference in the spot price and the future price, the reason behind it is only the cost of carry. Cost of carry means holding cost. Whenever there are the different kinds of holding cost, that is known as the storage cost, transportation cost, financing cost, number of the costs are involved. That is why the future prices differ from the spot price. You are going to hold the future for some period of time. Let us take an example of the commodity products. If you are going to take the example of the commodity products, then what you have to do? You have to take the you have to pay the rent of the warehouses where you kept the commodity for the certain period of time, and this is the cost. That is why there is a difference between the spot price and the future price. Cost of carry can be defined simply the net cost of holding a position. The most widely used model for pricing the future contract. The term is used in the capital market to define the difference between the cost of particular asset and the returns generated on it over a particular period. I will discuss this point with the help of an example in the next slides. In the case of the cost of carry model, again I have already discussed this thing that it is in the, if it is in the physical form, you have to pay the rent. But if you are going to take the leverage, it means you are going to take a loan and do the trading of the futures, then what you have to pay, my dear student, you have to pay the interest charges. Again, there are the certain costs which comes under the category of the cost of carry model. I will discuss one by one. What is the formula for calculating the future prices? This is the cost price plus cost of carry plus spot price. This is the future price, or we can say in a different term, that is the future price minus the spot price, you will get the cost of carry. There are the different types of the cost of carry. The one is storage cost, second one is the transportation cost, then there is the insurance cost, and the last one is the financing cost. I will discuss one by one all the costs. The first one is the storage cost. As we know that if the future trading is done on the basis of the commodities, then what you have to do, you have to buy the warehouse where you have to pay the rent. It will become the storage cost, and it's written also there, warehouses charges, rent of the warehouses and other expenses which are associated with the determination. There may be the normal wastage also. Normal wastage means if you are going to take the future of the coal, then there may be the chances of the normal wastage which are unavoidable. That's come under the calculation of the storage cost. In case of the financial instruments, as we know that the cost incurred on keeping the securities in the bank or with the custodians, and the insurance cost we will discuss, where you have to do the insurance of the product also. You have to pay the amount to the insurance company in the form of the premium. In the case of insurance, there are different types of the insurance. As we know that there is a case of the theft, there is a case of the fire. In the case of the physical commodities, where you are taking the future, and it will come under this category. There is a water damage, weather is there, natural disaster is there. So, there is a need of the insurance, and the insurance give the protection to the commodities where you have taken the futures. You have to pay the premium for the insurance, and the premium and other costs incurred on the insurance is called the insurance cost. Transportation cost, again it is a very important cost which comes under the category of the carrying cost model. If we will see that in the physical form, the goods are transferred from one place to another, and there is involvement of the cost. No goods can be transferred without the transportation, and you have to pay the amount for that. That is why there is a transportation cost. Transportation cost will be different from location to location, and also in the nature of the commodities. Nature of the commodity means if the commodity is relating to the physical commodity, just like the wheat, then the oil, then the seeds, there are different commodities. The prices of the location charges and the prices of the transportations are differ from one product to another. Our next point is financing cost. In the case of the future trading, you have to deposit some amount of the margin with the clearing house. If you will do the trading with the help of taking the loan from the bank, then you have to pay the certain amount of interest to the bank. Again, let us take an example. If you are going to deposit the amount of the margin, if the margin amount is let us take an example, it is 1 lakh. You have to take a loan from the bank, then you have to pay the interest on the 1 lakh, and the bank is charging, the rate of interest is 5% per annum. 5% per annum. Now, it depends whether you are going to take a loan from the 1 month or the 2 month or the 3 month, the rate of interest is going to be adjusted accordingly. Let us take an example. If you are going to take the loan for the one month, then 5 upon 100, this is the rate of interest, multiply by 1 upon 12. In this way, you do the calculation of the interest. You have the example is also given here relating to the gold, that you have 1% of the 5,000, that is a 50 rupees per month. You are paying the rate of interest. You have to do the calculation of this, then you will get the amount, that is 5,000 divided by 12. You will get the amount of the interest from there. Now, this is a formula for calculating the future cost of carry model. The formula is SE raised to power R plus S minus C multiplied by T. F stands for the future price of the commodity, S stands for the spot price of the commodity which is prevailing in the stock exchange right now. E, actually this is the basis of the natural log approximated as 2.718. Then R is the risk free rate of interest. S is the storage cost which are expressed as a percentage of the spot price. Then C is the convenience yield, and the last one is the time to delivery of the contract expressed as a fraction of 1 year. This is a numerical, it is a very simple. Suppose the spot price of the stock or the scrip X is 1600 and the prevailing interest rate is 7% per annum. Future prices of 1 month contract would therefore be, in this case we are going to calculate only the financing cost, as we know that in the case of the future pricing the formula is the spot price plus carrying cost. Here the carrying cost is the interest cost. How you can do the calculation? It is written here that this is the spot price, that is the 1600. Then you have to do the calculation of the interest. We are taking the loan of rupees 1600 from the bank and we have to pay the interest of 7% per annum for the 1 month. Now 1600 multiplied by 7% upon 100, here it is a 30 upon 365. Why the 30 is here? 30 is the number of the days in the month. This is the number of the days in the month, number of days in a month, then divided by the total number of the days in a year, total number of days. In a year, and the 7 is the rate of interest which the bank is going to be charged, rate of interest, and you are going to take the loan of how much? This is the amount, that is 1600. In this way the price of the future is going to be changed. Right now the spot price is 16, but the rate of interest is 11.51. In this case the future price will become 11.51. Now next example, this is relating the position of investor who are going to short. Short means they are going to sell the future, they are not going to buy the future of 1000 Tisco shares in May when the price per share is rupees 100 and close out the position of buying them back in August when the price of the share is 80. Here the company is giving the dividend of rupees 2 per share in the June. Now you have to do the calculation whether the investor is gaining a profit or losing a money. In this case you are going to short the future. In this the total amount of the future is 1 lakh. How you can do the calculation? It is 1000 multiplied by 100, it becomes 1 lakh in the May, and you are going to short the position. Short the position means you are going to sell the future, you are not going to buy the future in this case, and you will receive the amount of the dividend, that is 2000. How you do the calculation of 2000? It will become, the total number of the share is 1000, you have to multiply with the 2, then the amount of rupees 2000 will come and you will get this payment in the month of the June. Now when you are in the case of the short selling, we are generally sell at the higher price and buy at the low price. When the price of the share is 80, when the position is closed out, then you will get how much amount? That is 80,000. But the net profit what the investor is getting, we can do the calculation, that is 1 lakh we are investing and rupees 2000 is going to be deducted and minus 80,000. This is the closing position, the total amount of the profit which the investor will get, that is 18,000. Now this is another example which is very simple. Let us take an example. It's on April 11, 2003, the cash price of the gold is 5,000 per 10 gram and the price of the December future contract is 4,500. On April 11, 2003, the relevant annualized financing rate is in 12% and the storage cost is 0.5% per month. In this case, we are taking the two holding cost. What are those? That is the financing cost, and the second one is the storage cost, that is 0.5% per month. And we have to do the calculation of the carrying cost and the implicit annualized convenience yield from above data. How we will do that? This thing, first we have to do the calculation of the interest and the storage cost. The total amount which we are getting, that is 5,000 multiplied by 12%, this is the rate of interest. Then see, my dear student, in April and when it is going to be closed, December, they are the 8 months. We do the calculation by taking the number of the days in the 8 month. It will become 240 divided by 360, then minus what is it is 0.5% into 8 months. It will become 400. This is the cost of carry. This is the cost of carry. Now you have to do the calculation above, then 5,000 to calculate the annualized convenience yield. This is 5,000 plus 400 minus 4,500 multiply by divided by 5,000 and multiply by again, and now we are going to reverse is 360 upon 240. The amount which is come, it becomes 27.38%. In this way we will do the calculation. In this question there is a two costs involved. One is the financing cost and the second one is the storage cost, and the total cost will become 400 cost, that is the cost of carry. Then we are going to add the 5,000 plus this is 400, sorry, this is 400 minus 4,500 divided by 5,000 and do the reverse of this, that is multiply by 360 divided by 240. This is the annualized yield will come. Now the next one. Again, this is the crash price of Infosys stock was given, which is rupees 4,500. This is the cash price, which we can also known as a spot price, cash price or spot price. And the price for December future contract was given, this is rupees 4,000. This one is December. Contract price, and this 4,500 is the May contract. If you are going to calculate the difference between May and December, you will get 7 months. Now there are the 7 months, you can do the calculation with the help of 7 months. Again the financing cost is given, that is 15%. How you can do the calculation? That is 4,500. This is a spot price, multiply by 15%. This is the rate of interest. Then 7 upon 12. It will become rupees 315. This is the carrying cost. Now this is the spot price, I have already told you. Spot price. Now again you have to do the calculation of the implied convenient yield. How you can do that? This is 4,500 plus 315. This is the carrying cost minus 4,000 divided by 4,500 multiply by 12 upon 7. This is the formula. You are going to reverse it right now. Earlier you have to do the calculation 7 by 12, now 12 by 7. How much it will become? It will become 31.05%. In this way we can do the calculation relating to the stock price. Now negative cost of carrying. Is the cost of carry can be negative? It becomes negative, my dear students. When it will become the negative? When the spot prices less, future price is less than the spot price, and it comes under a very rare situation when the future price is less than the spot price, and it generally happen when the company do some kind of the splitting of the shares or going to give the bonus to the shareholder, then this situation may be come. This usually happen when the stock is expected to pay the dividend, or when the traders execute reverse arbitrage strategy that involves buying in the spot market and selling in the futures. Then this is going to be happen, but it can be happen that the cost of carry can be negative. Thanks. Today we have discussed about the future pricing, in which we have discussed the way how to calculate the cost of carry. Different numericals I have discussed. Please and in the next slide I am going to discuss about the currency futures. Thank you very much.